Okay, dear students, good evening to everyone. Let's start the first live revision lecture of SBR for the session December 2024. I hope that everyone has taken the study planner from the admin. If not, so please do ask the study planner. Admin is going to share the study planner with you. So today's topic is property, plant and equipment, IAS 16. So we'll be revising this IAS 16. It's the first live revision class. Okay. IAS 16, number one. Let us quickly discuss the definition of property, plant and equipment. Actually, property, plant and equipment means on what sort of property, plant and equipment we will apply IAS 16. Number one. Let's say there is a machinery which we are using in the production. So IAS 16 is applicable. Second, we have lorries. And what do we do with those lorries? Lorries are used to supply goods to others. For example, by using the lorries, we take manufactured goods from our business premises, deliver them to the premises of our customers. So on those lorries, IAS 16 is applicable. And we are using property, plant and equipment to provide services. For example, I'm using laptop to provide you the services. So obviously on that laptop, IAS 16 is applicable. For rental to others. Now, what do you mean by rental to others? Basically, I have given a property on rent and IAS 16 is applicable. But the question is that said in IAS 40 investment property, we also get rent. So how to differentiate? So it's very simple. When in IAS 16, when we are providing properties on rent, so we just do not only provide property on rent, we do provide significant ancillary services as well. The best example for this is hotel properties. Obviously, in hotel properties, we are not providing only a room on rent. We do provide proper and significant ancillary services. And this is not the case in case of investment property. If someone is given a bungalow on rent, so obviously on that bungalow, I'm going to apply IAS 40. But when it comes to the hotel properties, we are going to apply IAS 16. So that is the example of rental to others. Another point, administration offices. Again, IAS 16 is applicable. Another example is the owner occupied property. On owner occupied property, we apply IAS 16. Now, what do you mean by owner occupied property? Owner occupied property means where we carry out the normal business operations. So there's a building and in that building, we are carrying out the normal business operations. So obviously on that building, I'm going to apply IAS 16, property, plant and equipment. One more example. Assuming there is an APLC, there is an organization, and assuming that organization is having number of properties and that company also provides those properties on rent, but those properties are only given on rent to their employees only. They do not give that property to anyone else. They just provide property to their employees. And obviously, as soon as employment contract is over, that employee goes, the new one comes. So simply, those properties are given on rent, but they're only given to the employees. If this is the case, again, IAS 16 is applicable. Now, the second part of the definition is expected to be used more than 1 year. So simply the useful life of that property, plant and equipment is more than 1 year. And obviously they are tangible items having physical substance. Now, initial recognition. The recognition criteria in IAS 16 and other assets is almost same except IAS 37. So asset recognition criterion IAS 37 is different than all other IASs. So we will discuss when the time comes what IAS 37 says, but right now IAS 16, property, plant and equipment, initial recognition. An item of property, plant and equipment should be recognized as an asset when it is probable that asset's future economic benefit will flow to the entity. Means there are more than 50% chances that company is going to get the economic benefit. And second, cost of the asset can be measured reliably. If both the conditions are met, then obviously you are going to recognize the property, plant and equipment. Now, conceptual framework is there. So the revised conceptual framework says that elements are recognized if recognition results in. Element means we are talking about asset, liabilities, expense, income, and equity. Simply the head of accounts. So the revised conceptual framework says that elements are recognized if recognition results in relevant information, a faithful representation of asset or liability, and resulting income, expense, or equity movement. The recognition criterion IAS 16 and most other IFRS IAS standard differ from the above because the standards were based on previous version of the conceptual framework and were not updated when the conceptual framework was reissued. Now listen very carefully, very important concept. If there is a difference between conceptual framework and IAS, so we always follow IAS then we don't go for conceptual framework. The conceptual framework does not override the requirement of individual IFRS and IAS standards. The recognition of property, plant, equipment is therefore determined by reference to the criterion IAS 16. Property, plant and equipment should initially be measured at its cost according to IAS 16. Now, cost comprises. So simply, initially, property, plant and equipment will be measured at cost. Now the question is what comes in cost? Basically, each and every cost which is required to bring the asset in a workable condition initially, that will be simply capitalized. Like the purchase price, costs that are directly attributable to bringing the asset to the location and conditions necessary to operate. For example, the transportation cost. Another example is, let's say, taxes. Non-refundable taxes will become the part of cost of property, plant and equipment. Which taxes? Non-refundable. Obviously, if there are refundable taxes, they cannot be a part of your property, plant and equipment. Third, the estimated cost of dismantling and removing the asset, including any site restoration cost. There's a possibility, not necessary, but there's a possibility that at the end of useful life of the property, plant and equipment, your company is required to dismantle that plant and restore that area. If this is the case, then obviously present value of dismantling and restoration cost will be capitalized. So we have to calculate the present value of dismantling and restoration cost. So the double entry is with the present value, property, plant and equipment debit, provision will be credited. And we know that subsequently due to unwinding of discount, that provision will increase. And due to unwinding of discount, we will debit the finance cost and we are going to credit the provision. So this might apply where, for example, an entity has to recognize a provision for cost of decommissioning an oil rig or nuclear power station. So these are the example where normally you are required to dismantle and restore the area. IAS 16 says following costs should never be capitalized. Like general administration overheads will not be capitalized. Abnormal cost, repair, wastage, idle time will not be capitalized. Costs incurred after asset is physically ready for use. So when asset is physically ready for use, then obviously after that, whatever cost you are incurring, it will not become the part of your asset unless these costs increase the economic benefit of that asset. Look at this. When it says unless these costs increase the economic benefit of the asset, now they are talking about capital expenditure. So obviously, if subsequently your company is going to incur the capital expenditure. So definitely capital expenditure will be capitalized. And capital expenditure does not only mean that is going to increase the useful life of your asset. Actually, when we say capital expenditure, number one, due to that capital expenditure, efficiency of your asset can increase. There's a possibility due to capital expenditure, capacity of the asset will increase. But the main thing is either the efficiency increases, capacity increases. The main thing is now you will be getting more economic benefits as compared to what you have estimated earlier. So simply, when subsequently, if you are incurring any capital expenditure, so that will be capitalized. Costs incurred in the initial operating period, such as initial operating losses and any further costs incurred before a machine is used as it is its full capacity. Simply, whatever cost you are incurring in the initial period, so that cannot be capitalized, such as initial operating losses, any further costs incurred before a machine is used at its full capacity. See, your machine is available for use, it is ready to use. Now, if you are incurring any other cost in order to utilize that machinery at its full capacity, now you cannot simply capitalize it. So costs incurred in the initial operating period will not be capitalized. Cost of opening a new facility, introducing a new product, including advertisement, promotion, obviously you cannot capitalize. In fact, if you are providing training to your employees, it cannot be capitalized. Even training is, let's say, your employees, they cannot utilize the property, plant and equipment until unless you give them the training. Even this is the case, still the training cost will not be capitalized. Cost of relocating, reorganizing entities operations will not be capitalized. Now, this one is very important, the last area. There's a little change in IAS 16. And what is that change? Basically, in case of, let's say you have installed the property, plant and equipment. So obviously, you are going to have any, if there's going to be any, I would say, test running. As a result of testing, recently purchased, constructed property, plant and equipment products samples might be produced and that are sold. IAS 16 has been amended to require proceeds from such sales as well as the associated cost to be recognized in the statement of profit and loss as income. Previously, IAS 16 required these proceeds to be deducted from the carrying amount of the property, plant and equipment. So simply for producing samples, whatever costs you are incurring, that will go to simply income statement, and the revenue which you are generating from the samples, that will go to the P&L. Previously, cost was capitalized and the revenue was deducted from the carrying amount of property, plant and equipment, but now this is not the case. Testing cost goes to P&L, and any revenue which company is generated from selling the samples, that revenue will go to the income statement. Now, initially we know that initially IAS 16 says property, plant and equipment is carried at cost. Subsequently, IAS 16 gives us two models. One, you can still follow cost model. The second is revaluation model. Now, IAS 16 has given us the option, given us the choice, either to subsequently go for keep following the cost model or to go for a revaluation model. Very important concept. Since IAS 16 has given us the choice option, either to follow cost model or revaluation model, wherever you are going to simply listen the word choice option given by any IAS or IFRS, that is treated as an accounting policy. Actually, accounting policy means right to choose. So now your company has a right to choose either to apply cost model, subsequently follow the cost model, or revaluation model. It is up to you. Because you have the option, you have a choice. Okay. Now, according to the conceptual framework, I would say it is the duty of preparer of financial statements. They should provide relevant information to the user of financial statements. Repeat, okay? What framework says? Framework says actually it is the duty of preparer of financial statements to provide relevant information to the user of financial statements. Now, what do you mean by relevant? Now try to understand. Obviously, IAS 16 has given us the two options, cost model as well as revaluation model. But the framework says, for example, let's talk about a machine which we are using in the production. So normally what happens, the property, plant and equipment, the plant and machinery which you are using in the production, normally their market value will not change so much. Second, obviously normally there will be no intention to sell that machine. Normally we are going to utilize the machine to the end of its useful life. So in that case, it is more relevant to keep the machine at cost model. But when it comes to the building, land and building, so obviously due to the changes in the market circumstances, the value changes. So the framework says it is more logical to keep that land and building at revaluation model. But just conceptual framework has given you the idea. Obviously, it is pure judgmental. It purely depends on the user of financial statements. What do they think? Following the cost model is more relevant for the user of financial statements, or following the revaluation model, which model is more relevant for the user of financial statements? Look at this. There are both the models under the conceptual framework as well, historical costs and current values. If an accounting standard permits a choice of measurement base, such as in case of IAS 16, conceptual framework notes that preparer of financial statement must aim to maximize relevance. To do this, the preparer should consider the characteristics of asset or liability, the ways in which asset and liability contributes to the cash flows. Now look at this. Many items of property, plant and machinery generate cash flows indirectly by being used in combination with other assets to produce goods for customers. As such, conceptual framework notes that historical cost is likely to provide the most relevant information. However, some items of property, plant and equipment such as land and buildings are highly sensitive to market factors. Over time, particularly when prices rise, the fair value of land and buildings may materially differ from the purchase price. As such, it may be that a measurement based on current value provides more relevant information about the financial position of the reporting entity. Such decisions are judgmental. Preparer must ensure that the qualitative characteristics of useful information are maximized as far as possible. So actually, if you are the preparer of the financial statements, so simply it is your duty to provide more relevant information to the user of financial statements. Okay, when an entity follows the cost model, under cost model, property, plant and equipment is held at cost less any accumulated depreciation and impairment. In case of revaluation model, under the revaluation model, property, plant and equipment is carried at fair value less any subsequent accumulated depreciation and impairment losses. Now, very important concept. Either your company is following the cost model or the revaluation model. Make sure all assets, they belong to the same class. They will all follow the same model. In case of cost model, all will have the cost model. In case of revaluation model, all will have the revaluation model. If the revaluation model is adopted, then IAS 16 provides the following rules. Revaluation must be made with sufficient regularity to ensure that carrying amount does not differ materially from the fair value of at each reporting date. Now, let me explain this. Listen carefully. What is written? If you are following the revaluation model, revaluation must be made with sufficient regularity. Now, listen. Whenever we are discussing revaluation model, either under IAS 16 or let's say or under IAS 38, under revaluation model, it is not necessary, it is not required that every year you have to revalue your asset. It is not required. If you want to do that, go ahead. But that is not required. That is why they are saying in case of revaluation model, revaluation must be made with sufficient regularity. They're not saying annually. They're saying sufficient regularity. It could be annually if you want. Otherwise, it could be after every 3 years. It could be even after every 5 years. But now, any IAS or any IFRS in which the term comes the fair value model. Fair value model means on each reporting date, if that fair value model is applicable on asset, then on each reporting date, you have to revalue and you have to calculate the fair value of that asset on each reporting date. If it is a liability which is capped at fair value model, then on each reporting date, you have to simply revalue the fair value of that particular liability. So fair value model means on each reporting date, you have to see what is the fair value right now. But in case of revaluation model, revaluing the asset every year on each reporting date, it is not required. Another important point, an item is revalued, the entire class of asset to which the item belongs must be revalued. And obviously, let's say if there is a property, plant and equipment having carrying amount 100 million, and let's say first time we are revaluing this asset and assuming revalued amount is 120. So this asset from 100, it will become 120. So we have to recognize the revaluation surplus 20 million. What will be the double entry? Very simple. Property, plant and equipment will be debited by 20. Revaluation, which will go to OCI, other comprehensive income, will be credited by 20. There's one more possibility. Let's say property, plant and equipment carrying amount is 100 million. Assuming that is 100 million. And we want to revalue the asset first time. Assuming, I'm just assuming, okay, that revalued amount is 90 million. And previously this asset was not revalued at all. This is the first time. So when you are revaluing the asset first time and instead of increase in the value of asset, if there is a decrease, let's say there's a decrease of 10 million, this 10 million will go to the income statement. And logically that 10 million is your impairment loss. So previously in example B, there's no revaluation surplus. So this 10 million is simply, you can say this is your impairment loss. That will go to the income statement. And property, plant and equipment will be credited by 10. So when you are revaluing the asset first time, if there is an increase in the value, so simply property, plant and equipment will be debited and revaluation surplus OCI will be credited. Another example, assuming we have a property, plant and equipment and the carrying amount is, I'm just assuming again 100 million. Example C. And this 100 million includes revaluation 10 million also. This 100 million includes 10 million revaluation as well. Okay. This asset is sold for 125 million. Now, please try to understand the scenario. Carrying amount is 100 million, which includes the revaluation surplus of 10 million. And we have sold this for 125 million. Now, let's say cash of bank is debited by 125. Property, plant and equipment will be credited by 100 million. Gain on disposal. Gain on disposal. Profit and loss, that is 25. Now, the previous revaluation will be close to the retained earning. The previous revaluation will be close to the retained earning, and the double entry of that will be OCE will be debited. OC, other component of equity will be debited. O, other component of equity will be debited by 10. Retained earning will be credited. So important thing is, when we are closing, when we are selling the property, plant and equipment, which has the carrying amount is also having the revaluation surplus, then that revaluation surplus is close to the retained earning. Now we debit other component of equity, OCE debit, and retained earning will be credited. And a student, I'm bit, I would say quick, just because it's a live revision class, okay? You people have already seen all the lectures. Relating to, I would say, this IAS 16, we have discussed this. Now depreciation. Obviously, all property, plant and equipment, they have a finite useful life. They will be depreciated. That is why we cannot depreciate land, because it has indefinite life. Residual value is an estimate of net selling proceed received if asset was at the end of its useful life and was disposed of today. So residual value is just an estimated net selling proceed. If the asset was at the end of its useful life and was disposed of today, so what amount you will get? That is your residual value. Now the question is, what is the importance of residual value? Now let me explain the importance of residual value. There's one concept. The name of the concept is depreciable cost. Students, can anyone tell us? Depreciable cost. Can I say depreciable cost is equal to cost minus residual value? Depreciable cost is actually equal to cost minus residual value. According to IAS 16, when your property, plant and equipment is ready to use, when it is available to use, you will start depreciating the asset. Repeat. When property, plant and equipment is available for use, when it is ready to use, you will start depreciating the asset. Now, there is a possibility that depreciation starts earlier than actual usage of the asset. Assuming employees, they need 6 months training. After the training, they will be able to utilize the property, plant and equipment. But property, plant and equipment itself, it is ready to use. So you will have to depreciate the property, plant and equipment even it is idle. So according to IAS 16, the concept is, when your property, plant and equipment is ready to use, you will start depreciating the asset. And according to IAS 16, we depreciate the depreciable cost. Depreciable cost means cost minus residual value. So depreciation is charged to the statement of profit and loss unless it is included in the carrying amount of another asset. For example, if you are a manufacturing company, then we know that now depreciation will become the part of a cost of your asset. So if this is not the case, then depreciation will go to the income statement. Depreciation begins when the asset is available for use and continues until the asset is derecognized, even if it is idle. Depreciation must be allocated on a systematic basis, reflecting the pattern in which assets' future economic benefit are expected to be consumed. In practice, many entities depreciate property, plant, and equipment on a straight line basis. Now, let me explain. According to IAS 16, you have to depreciate the asset, obviously, over its useful life. So according to IAS 16, depreciable cost will be depreciated over the useful life of the asset. But what is the depreciation? Now listen, depreciation is the systematic allocation of depreciable cost. Systematic allocation of depreciable cost over the useful life of the asset. So actually depreciation is the systematic allocation of depreciable cost. Now quickly, what do you mean by systematic allocation? Actually, systematic allocation means depreciation method. Depreciation method should match with the pattern of economic benefit. Repeat, depreciation method should match with the pattern of economic benefits. Now the question is, what do you mean by pattern of economic benefits? Now listen, depreciation method should match with pattern of economic benefits. For example, by using the asset, assuming more or less we are getting the same benefit, go for a straight line then. Go for a straight line method. But if when asset is new, let's say company will get the more benefit, and later on company is going to get the reduced benefit. If this is the case, more benefits in early years and reduced benefits in later years, then you will go for written down value, reducing balance method. Then you will go for written down value, you will go for reducing balance method. So you need to make sure that depreciation method should match with the pattern of economic benefits. Example, let's talk about the building which is being used in the where we are carrying out the normal business operations. Let's say from the building we are getting more or less the same benefit, go for a straight line. But when it comes to the plant and machinery which we are using in the production process, normally what happens? Normally, when your plant and machinery, they are new, you will be getting their efficiency will be high, you will be getting more economic benefits, but with the passage of time, you will get the reduced benefits. So it means for those, or then it means we can say that for plant and machinery, reducing balance method is more suitable. But the important point is, if pattern of economic benefit changes, if pattern of economic benefit changes, then you have to change the depreciation method. And change in depreciation method is treated as change in estimate. And change in estimate is always applied prospectively. Repeat, okay? If your company they have realized that economic benefit pattern has changed. For example, in COVID, in the era of COVID, of course, economic benefit pattern was changed altogether. So if you have realized that economic benefit pattern has changed, so you have to change the depreciation method. An important concept is change of depreciation method is treated as change in estimate, and change in estimate is applied prospectively. Change in estimate affects the present financial statement and the future financial statements. Change in estimate will not affect previous financial statements. Change in estimate will not affect the financial statement of the past. It never affects. Change in estimate will create the impact in present financial statements and the future financial statements, but it will actually have no impact on your previous financial statements. Okay. Depreciation method based on the revenue. See, this is not acceptable. If an entity says we want to depreciate the asset according to the revenue, for example, if we are generating more revenue, more depreciation, less revenue, less depreciation, so that's not an acceptable. Depreciation method based on revenue generated by an entity are not appropriate. This is because revenue reflects many factors, such as inflation, sales prices, and sales volumes, rather than economic consumption of an asset. So simply, if you come across an exam that company wants to depreciate the asset according to the revenue, more depreciation, less revenue, so it is not acceptable. Another important concept, depreciation method, residual value, useful life. Depreciation method 1, residual value 2, useful life 3 of an asset should be reviewed annually and revised if necessary. Any adjustment are accounted for as a change in accounting estimate, and change in accounting estimate is applied prospectively. The day you have changed these things, from that date onwards, the new estimate will apply. Another concept is the concept of componentization. Now, what do you mean by componentization? See, the main concept of the componentization is there are number of assets which are the combination of multiple components, and interestingly, where each component is having a different useful life. For example, an aeroplane, obviously in case of an aeroplane, interior cabin fittings will have a different life, exterior structure will have a different life, seats of the aeroplane will have the different lives. So the concept is, if you come across such an asset which is itself is the combination of multiple components where each component is having a different useful life, so simply you have to depreciate each component over according to their useful life separately. Now you cannot depreciate the entire asset on a single useful life. It is not possible. So in case of componentization, each component will be depreciated separately because every component will have a different useful life. For example, if seats, let's say, seats in an aircraft, assuming they have a useful life of 3 years. So what are you going to do? You will depreciate them over 3 years, and obviously after 3 years, old seats will be replaced with the new seats. And we are going to de-recognize the old seats and we are going to recognize the new seats. Repeat, in case of componentization, where the asset which you can see is itself the combination of multiple components where each component is having a different useful life. Simply, the main concept is only one. The concept is each component will be depreciated separately over its own useful life. That's very simple. There's one possibility, if two or three components, if they have the same life, then obviously you can club them and you can depreciate them together. But normally each component will have a separate life, so it will be depreciated separately. And let's say if the life has completed, so old component will be replaced with the new one will be recognized, and the previous one will be simply derecognized. Then there's one more concept of, I would say, inspection. So what is that? Basically, listen carefully relating to the inspection. For example, if you have to carry out the major inspection, let's say after every 2 years, after every 3 years, you have to carry out the major inspection. So such major inspections will be capitalized and will be depreciated over its own useful life. For example, let's talk about an aeroplane company. Assuming, according to the Civil Aviation Authority, after every 3 years, your aircraft, they need major inspection. And assuming that major inspection per aeroplane will cost, assuming $3 million. And you have to bear that $3 million after every 3 years. So simply that $3 million will be capitalized and it will be depreciated over 3 years. So simply major inspections will be capitalized. So depreciation should be charged separately on each significant component parts of an item of property, plant, and equipment. Parts which have the same useful life can be grouped together. Derecognition. I-16 says the assets should be derecognized when disposal occurs or if no further economic benefit are expected from the asset use or disposal. The gain or loss on the derecognition of an asset is the difference between the net disposal proceed, if any, and carrying amount of the item. When a revalued asset is disposed of, any revaluation surplus may be transferred directly to retained earnings, or item may be left in the revaluation surplus within other component of equity. If you want, you can derecognize, you can close the revaluation surplus to the retained earning. Otherwise, it is up to you. If you don't want to close the revaluation surplus to the retained earning, let it be in the remain in the other component of equity. There's no issue at all. But normally, at the time of disposal, we close the revaluation surplus to the retained earning. Disclosures. I-16 requires entities to disclose the measurement basis, that is cost or revaluation, which one you are using it, useful lives, depreciation rate, at what rate you are depreciating the asset, reconciliation of carrying amounts at the beginning and end of the period. If items of property, plant, and equipment are stated at revalued amounts, information about the revaluation should be disclosed. Okay, now there's one test your understanding one. Students, just read this and within 2 minutes, Azan is also sounding right now. So within 2 minutes, we'll start the discussion of this question. I want everyone to read it, please. Okay, students, explain how the above items of property, plant, and equipment would have been accounted for in all relevant reporting periods up until December X5. CAP bought a building on 1st January X1. The purchase price was 2.9 million. Associated legal fees were 0.1 million. Can I say the 0.1 million will be capitalized? So basically your building is having 3 million cost. General administration costs allocated to the purchase were 0.2 million. Can I say 0.2 million will be expense out? It cannot be capitalized. We have just discussed. CAB also paid sales tax of 0.5 million, which was recoverable, which was recovered from the tax authorities. Can I say tax paid, which is recoverable, cannot become a part of your cost. The building was attributed a useful life of 50 years. it was revalued to 4.6 million on December X4 and was sold for 5 million on December X5. Okay. How will you answer? Let me just give you the answer plan. And then please, I want everyone to draft. Number one, please. The volume which examiners they produce in their answers, obviously nobody's expecting from the student to produce the same volume. There's no expectation. Main thing is, there's no issue you write less, but you write correctly, you will get marks. You are writing too much, all irrelevant, you will not get marks. So marks, you will not earn marks just by writing. You will earn marks by writing correctly. Focus on that. You will earn marks by writing correctly. So what you have to write, let me just explain, and then I want everyone to do the drafting part. The building. Simply the first thing which you have to just tell your examiner that initially building will be measured at cost. That's the number one point. Initially, building is measured at cost. Purchase price plus legal fees. Therefore, can the cost is 2.9 plus 0.1. It is 3 million. Then obviously journal administration cost is expense out. Journal admin cost is expense out. Recoverable tax cannot be capitalized. Recoverable tax cannot be a part of your cost. Okay. Then can I say building will be depreciated over its useful life? Building will be depreciated over its useful life. And if you don't forget, we did discuss one thing, that depreciation method should match with the pattern of economic benefits. And normally, I'm not saying always, but normally we'll be getting the same benefits from building. So straight line method is more suitable, and examiner is going for straight line method here. Under straight line method, what do we do? Cost minus residual value divided by useful life. But obviously, when there is no residual value, then cost divided by the useful life. Okay, now. So annual depreciation. 3 million divided by 50. Can I say the annual depreciation is 0.06 million? Now, when we are revaluing the asset on December X4, we bought the building on January X1. We are revaluing on December X4, means after 4 years. So before revaluation, we have to first calculate the carrying amount of the building. December X4, please, you have to write properly, building less accumulated depreciation. So simply 3 divided by 50 into 4. I'm getting 0.24. So the carrying amount of the building before revaluation, it is 2.76. Now this 2.76 will be compared with the revalued amount, which is 5 million. So revaluation surplus. Can I say 5 minus 2.76? It is 5 million, or it is 4 it's not 5, it is 4.6. Okay. 4.6 minus 2.76, I'm getting 1.84. Okay. Simply building is debited by 1.84 million. Revaluation, OCI, other comprehensive income, credited by 1.84. Now, December X5, this building was sold for 5 million. Obviously, after revaluation, we will depreciate the asset over its remaining life. After depreciation, after revaluation, we will depreciate the asset over its remaining life. So December X5, before selling the building, we have to calculate the carrying amount, 4.6. Depreciation will be 4.6 divided by 46, 0.1. So the carrying amount of the building is 4.5. Now we have sold this for 5 million. Simply bank debited by 5 million. Building credit by 4.5. Gain on disposal will go to income statement. Gain on disposal. Previous revaluation surplus will be close to the retained earning, or if you don't want to close, it's okay. Other component of equity. Simply revaluation surplus, other component of equity will be debited by, it was 1.84 million. Retained earning will be credited. And I have explained in my regular classes also, only in the year of revaluation, when the revaluation comes, that revaluation is shown in OCI. And obviously, when you are selling the asset subsequently, so now OCI will not be affected. Simply OCE debit, retained earning will be credited. Okay, now come here. Cap purchase a machine on 1st January X3. So student, you have to just explain what should be done before disposal. You have to first calculate the carrying amount of the asset, 1 point, and then you have to explain on disposal, gain or loss goes to income statement, and previous revaluation surplus is close to the retained earning. Cap purchase a machine on 1st January X3 for 1 lakh. Attributed at useful life 10 years. On 1st January X5, Cap reduced the estimated remaining useful life to 4 years. Change in useful life is change in estimate, and change in estimate is applied prospectively. Now, what is happening in X3? We are required to depreciate over 10 years. X4, machine will be depreciated over 10 years, but after 2 years, useful life has changed. Now, after 2 years, we are saying the remaining life is only 4 years. Now, listen. Machine annual depreciation for first 2 years, 100,000 divided by 10, obviously 10,000. Now, 1x3 machine, the cost is 1 lakh, accumulated depreciation is 20,000. So the net book value is, carrying amount is 80,000. Now this 80,000 will be depreciated over the change life, and the life has changed to now only 4 years. Now the remaining life is only 4 years. So now this 80,000 will be depreciated over the remaining life, which is just 4 years. It is mentioned in the question. Reduce the estimated remaining useful life 4 years. So remaining life is just 4 years. So annual depreciation X3, 80,000 divided by 4, it is 20,000. And change of useful life is in change in estimate, which is applied prospectively. So students, I think in a very short period of time, I have tried to give you the each and every concept of IAS 16, property, plant and equipment. Because the whole objective of the live revision classes is to revise obviously number of areas in a very short period of time. Because if we start spending the same amount of time which we have spent in our regular classes, then what is the benefit of revision? Because the regular classes are already there. Okay, now one more thing. After what is going to be the next topic, I'll update in your WhatsApp group. Now, in the next class, of course, it will not be a one IAS or two. Now, obviously, number of IASs will increase, which we are going to revise in the next class. At least we are going to revise, I would say, 3 to 4 IASs. So slowly and gradually, students, please, you need to speed up, push yourself, try to, watch lectures as soon as possible. So in the next class, obviously, the timing of the class will increase, number one. Duration of the live revision class will increase, number one, and slowly and gradually frequency of live revision classes will also increase. Plus, exactly maximum, I would say 2 weeks, but I think just after 1 week, I will start uploading the practice videos as well. And I'll keep guiding when to watch those practice videos. So students, you are just supposed to follow the planner plus all the instructions, which slowly and gradually I will keep providing you in your relevant WhatsApp groups. So thank you very much for today's class. Since it is the first live revision class for December 24 session, so I don't want first class to be very long. And since it's a revision class also. So thank you very much that you people have taken out time for today's class, and please do give the feedback of today's class in your relevant WhatsApp group, and hope to see you all. This class will be uploaded, of course, and there will be one, they are going to make a one folder, and the caption of that folder will be live revision classes for December 24 session. So, and that folder will be at the end of all other videos. So students, thank you very much. Do give the feedback in your relevant WhatsApp group about the first live revision class.